This short clip is from my live trading room. You can engage directly with my fabulous team and me at LaDucTrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. We have pre-market the gyrations of a ceasefire yesterday that ended, or was going to at 3 a.m. Tehran time, and then Trump extended it. So if you can see from this kind of head and shoulders pattern on the cues intraday for the 2 hour, same thing for SPY. We'll see if that does a nice little job of pulling back. But for right now, again, this was ceasefire is imminent, and then Trump wanted to extend it, even if Iran's warned everyone in the GCC, the Gulf Arab countries, basically to leave because escalation is about ready to begin. Anyway, hot war reports incoming is still not priced in because mechanical buying is still on the house, which we've talked about a lot. Something else that we talked about, if you recall, I did a midterm playbook crash up into a correction scenario, and this is from Monday's live trading room. Remember, I did this kind of strong earnings expectations led by tech in general. Micron in particular are supporting market fundamentalists despite the U.S.-Israel war on Iran supply shocks. Don't be complacent. Midterm seasonality has its own ideas. All right, so this was what came from my live trading room. We just used it as a snippet for our LaDuc trading channel on YouTube. Anyway, long story short, what do we have this morning? But Tom Lee coming in. I'm sure he's not in the room, but it's kind of funny. Anyway, he predicts the S&P will reach 7,300. I've got 7,190, but same idea. Could push all the way to 7,400, et cetera, et cetera. We really don't know because we have blue skies, which means we have no resistance above. That's the whole definition of blue skies. Anyway, then he predicts a followed 15 to 20% drawdown before rallying back up to 7,700. So kind of key exact turn of a phrase, which is that mid-election year playbook that I went over in detail Monday morning. Anyway, it's kind of ironic. This is how Wall Street works. And I mentioned that market memory, it's an auction of buyers and sellers, and it has a predictability. It has probabilities, and the probabilities are that we will have a 18 to 20% pull down, which is what I said on Monday, according to this mid-election playbook scenario. And then we will move higher 33%, 33 to 35%. And it has an incredibly strong hit rate. So in other words, the probabilities of this happening statistically are extremely strong. So that's why I pulled that up. And remember, I said, wow, we could really have a pretty good pullback, maybe not to the May 2025 gap down, but it's a potential. And then we rally right back up into midterms. It's exactly what I said. All right. So anyway, we've got this making the rounds, which by the way, can also help this self-reinforcing expectation. So if Tom Lee says it, and Mike Wilson is 7,600 guy, and we basically have a lot of Goldman Sachs, remember my piece a few weeks ago, generational buying opportunity, et cetera, et cetera. So what we have is a lot of folks that are still gung-ho during earnings season. And then we have some concerns, which is around the oil market. So let me just show you a few of the reasons why we could pull back 20%. And one of them has to do with kind of the earnings hype. Right now, I'm just showing you kind of the pre-market and talking through pre-market rant kind of stuff. Some of that has to do with earnings. We've got a situation where we do have AI, which is right now, as we assume, but we can also show it in data, that it is kind of masking a slowing economy. Earnings are very excitable. The expectations are higher, 15 to 20% growth ahead. Seriously, they chase this expectation and they drive the prediction markets also to get there. So it's an earnings bonanza as good as it gets, but it's very narrow, which is what I also talked about on Monday. It is very much a narrow market. I showed you some of these other charts, if you recall, from Monday as well, which is forward 12-month S&P earnings projections are strong, and they are especially strong for 2026, 2027 as it relates to tech. In reality, however, they're a little bit too optimistic, and this is what usually happens is then we miss it and the market painfully reprices And then this is just kind of some other charts, basically, economic indicators, all the stuff that I've shown you before, just kind of giving you a feel for once we get through the bulk of earnings season. Buybacks also are starting to trend a little bit lower. Anyway, we've got economic data that's also lagging, so that's not really going to help us so much as it relates to earnings and GDP. Sometimes they move together, sometimes they don't. Right now, we're pulling forward lots of expected growth, but then in reality, you have something like United Airlines this morning that said we had a stellar quarter, but our guidance for the future, we need to cut in half because we don't know what this is going to do as it relates to the oil price, jet fuel. There's no EV equivalent. I showed you this chart as well about how narrow the rally has become specifically with Micron. Remember that? Anyway, airlines are out saying, hey, we can't predict the future because we don't know where jet fuel prices are going to be and how that's going to weigh on demand as well. So the cure for high prices, high prices. So we've got this situation where looking backwards, earnings have been great. They've already increased expectations in the future, but guidance is the real tell. And then, of course, the sustained oil price is going to become a big issue. So right now, you've got the commodities and AI boom, which is driving so much of the earnings expectation. And it's concentrated narrative, concentrated rally, AI, tech, capex boom, all the stuff that Tim is trading. Very well, because that's what's moving higher, while the consumer, however, is cracking. We've got spending has already slowed down. Income is already weak. Confidence is downright depressed. So we've got stock market at all-time highs and consumer confidence at all-time lows. Savings is below trend. The energy shock is hitting the pocket. The tax rebates, if you will, are definitely benefiting the asset holders, not as much the K-shaped economy, et cetera, et cetera. So I guess what I'm trying to say is it's not a backdrop for a continued earnings boom. So this is going to start to get priced out. That's important. Now, to negate or to add ballast to that is the fact that we have a new Fed chair coming in who is very much a sock puppet, right? Wants to dovetail with what's going on with the Trump, Bessent, and Lutnick administration saying rate cuts, rate cuts, rate cuts. And this is probably going to follow through, by the way. Not as much the QT. I think there's a lot of talk there, but not a lot of walk. But in any case, you've got a situation where we've got Bessent now going to get his wish with partnering with partner in crime, which is going to be Kevin Warsh as Fed chair. And they're going to be able to cut rates and continue to finance the ever exploding deficit with short duration T-bills, not longer duration notes and bonds, which are liquidity sucking. Anyway, they're trying still to squeeze more juice out of this lemon, which is the markets. And right now it has turned from the end of quarter, the mechanical buying that triggered short covering on the ceasefire announcement. We still are at war with Iran. Unfortunately, this is not going away anytime soon. The Strait of Hormuz is still blocked. That doesn't look to be letting up anytime soon. But the market then had the short covering rally that then got institutions coming in off the sidelines and then retail added at the very, very end. So now we're going to be into this kind of compression right now. Vol is definitely compressing. It's still underneath a key level. Macro noise right now is starting to fade because they believe the market knows something that we don't, basically, that it's not the sustained oil prices aren't going to get in the way, but it is going to get in the way. So the longer that oil prices stay very heavy and high, this is a tough chart to show you, but I want to get through it. You've got a situation where you've got refined products taken off the market, tons and tons also of whatever is going on globally with refineries blowing up and such. So we have some concerted effort of sabotage, espionage, however you want to put it. Anyway, each progressive week becomes more or disproportionately more disruptive. It's a mouthful, but we can't just go right back online like nothing happened. So anyway, this is the short-term reflexive bounce that we're in, but longer term, we're definitely going to have a bigger issue. A client actually pull up again their Gemini assessment of what happens, and the true point of no return is June 1st. Not that far away if you think about it. The squeeze that we're in, or the buying that we're in, could definitely last until the end of May. I can see that. Goldman is out saying CTAs are still buying a few billion a day. So that can help sustain the market. Any dip is getting bid, but becomes a logistical hole that is too deep to fill for any strategic reserve if the strait is still closed by June 1st. And that's just some food for thought. And this another assessment, again, client fed, so I'm appreciative, but I don't usually rely on any of the AI for analysis, but it was good food for thought, which is the real window is 20 to 25 days, not 30, before the May refinery stress becomes visible and disorderly rather than managed. And then you've got also zero hedge is a little bit more gloomier, but the point is shut-ins are ugly once in place. The ability to restart production depends greatly on overall viability of infrastructure. And if it's old and worn out or blasted, it can lead to permanent halt. We've already got Kuwait and others with force majeure and billions in new capex that are needed to repair the infrastructure. Anyway, we are seemingly having a plan where that is exactly Trump's plan, is to cause economic pain to Iran and also China. But for right now, China has not responded with any escalation, just words. And in the meantime, we're kind of hanging back, and we don't have a solid read on when this is going to end. But we can definitely see that the oil offline is going to help contribute to that 15 to 20% drawdown, in addition to earnings as good as it gets. So those are at least two reasons why I can see, if you're looking for macro, after this reflexive bounce has exhausted itself, the same thing I talked about in the mid-election year playbook, then we do have earnings as good as it gets, number one, and then we have oil offline as a contributing factor and a war that does not end.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.